Hello and welcome. I'm Amy.
And I'm Tom.
Today is June 18th, 2025, and we're taking an in-depth look at what's happening in global markets.
Yeah, we'll be digging into the economic signals, the geopolitical stuff that's shaping things.
Exactly. Our goal here is really to cut through all the noise, help you quickly get a handle on what's actually moving the needle and maybe why.
We'll look at Wall Street's recent dip, some interesting shifts in how investors are feeling.
Right. And energy markets always volatile, plus what the central banks, particularly the Fed, might be thinking.
It's a packed agenda.
It is. So let's dive right in. We saw that downturn in U.S. stocks on Tuesday, the 17th. Can you give us the numbers, maybe what kicked off that cautious feeling?
Sure. So Tuesday, the S&P 500 dropped just under 1%, negative 0.84% to be exact.
Okay.
The NASDAQ 100 was down a full percent, and the Dow Jones Industrial Average fell about 0.70%.
These are pretty much across the board.
Very much so. 10 out of the 11 S&P 500 sectors were down. And yet the immediate reason people pointed to was worry about the Middle East.
Escalating tensions there.
Right. The concern that the U.S. might get drawn in more directly. It's that classic geopolitical risk factor playing out.
Always amazing how quickly that stuff hits the markets. But, beyond just the headlines from one day, what else is going on with investor thinking? Feels like something bigger might be shifting.
Well, that's what's really fascinating here, how quickly sentiment can really change. If you look past the immediate news, there was a recent Bank of America fund manager survey.
Ah, the Buffet survey. Always interesting.
Exactly. And it shows this, well, significant underlying change in what investors expect long term. They asked for a 5-year forecast. First time they've done that.
5 years, okay.
And get this, 54% of the asset managers expect international stocks to be the top performers over the next 5 years.
Wow, 54%. International.
Yep. Compared to only 23% for U.S. stocks. Big difference. Gold got about 13% of the vote, bonds just 5%.
That is a huge swing from, the last decade where U.S. tech felt like the only game in town. What does that suggest? Where's the money looking now?
It really suggests a potential rethink about where the growth and value will be down the road. And adding fuel to that, the survey showed a net 31% of investors are underweight the U.S. dollar.
31% underweight the dollar.
Yes, the most negative they've been on the dollar in 20 years. And a net 36% said they were underweight U.S. equities.
Okay, so this isn't just a little tweak.
No, this feels more strategic. It hints at maybe a longer-term shift away from that U.S. market dominance we've gotten used to. Investors seem to be looking wider, reassessing the fundamentals globally.
So zooming out, it sounds like investors are really starting to diversify their outlook, maybe questioning some long-held assumptions about U.S. market supremacy. That's quite a change in mindset. Now, away from the big indices, there were some specific company stories making waves. The solar energy sector, for instance, took a real hit. What happened there?
Yeah, solar stocks just plunged on Tuesday. This wasn't about earnings or anything like that. It was policy.
Policy-driven.
Directly. It came after Senate Republicans decided to uphold a complete phase-out of solar and wind energy tax credits, part of President Trump's proposed legislation.
And the market reaction?
Immediate and brutal. Sunrun shares plummeted over 40%. Entrace Energy dropped nearly 24%. First Solar lost almost 18%. Just shows how sensitive that sector is to policy support.
Wow, 40% on Sunrun. That's a massive hit from one decision. Really highlights the political risk in certain sectors. Any other corporate news stand out? Acquisitions, big strategic moves?
Definitely. On the M&A side, Eli Lilly announced they're buying Verve Therapeutics, a gene editing startup.
Gene editing, okay, big deal.
About $1.3 billion upfront. Verve's stock absolutely soared, up over 81%. Lilly's dipped a bit, about 2%, which is pretty normal for the acquirer.
Shows the excitement for biotech innovation, though.
For sure. And then SoftBank raised almost $5 billion selling T-Mobile shares.
SoftBank, right. What's the plan for that cash?
They specifically said it's to fund their AI ambitions. Just shows you where the big money is flowing. AI, AI, AI.
Everywhere.
And one more, kind of interesting on the consumer side. Kraft Heinz said they're going to remove artificial dyes from their U.S. products by the end of 2027. Apparently, that's partly due to scrutiny from the Trump administration.
Interesting. Regulatory pressure, consumer pressure, maybe?
Seems like a mix. Shows how even big food companies have to adapt.
So, quite a range of things happening at the company level. How did all this feed into the broader S&P 500 sectors? Any surprises in terms of winners and losers on a day the market was down?
Yeah, it's actually pretty interesting. Despite the overall market being down, the energy sector was the best performer. It gained just over 1%.
Energy was up, even with the market down.
Yep. Names like Valero, Marathon Petroleum, Chevron, all up. suggests that oil price jump, the geopolitical risk, really dominated for that sector.
Makes sense. And the worst performer.
That was healthcare, down over 1.6%. Companies like Biotechne, Align Technology saw some significant drops.
And the big tech names, the
Yeah,
mega caps.
a bit mixed there. Tesla had a sharper fall, down almost 4%. Others like Alphabet, Microsoft are down, but much less, like under 0.5%.
Okay. So speaking of energy being the winner, let's link back to those Middle East tensions. How did commodities react overall? Oil, gold, silver, was it just nerves or real supply worries?
Well, the reaction was pretty clear. Gold ticked up slightly, about 0.17%, just under $3,390 an ounce. That's that classic safe haven buying you see when tensions rise, like between Iran and Israel.
Right, the flight to safety.
Exactly. At the same time, though, the U.S. dollar got stronger. The dollar index was up almost 0.7%. That makes gold more expensive for anyone buying in other currencies, so it might have capped the gains a bit.
Interesting dynamic. What about silver?
Silver actually surged, up almost 2%, over $37 an ounce. That's its highest level since way back in early 2012.
Wow, silver having a moment. But the big story was oil, right? You mentioned prices jumped significantly.
Absolutely, more than 5 percentage points.
Okay.
Brent crude ended up just under $77 a barrel, WTI crude over $75.
Oh.
Big moves.
That's a really significant jump for one day. So the key question is, was this just markets pricing in risk, or was there an actual hit to supply?
It's a mix, but the risk factor is huge right now. While there weren't, major global supply interruptions reported, the conflict did have direct impacts. Iran apparently suspended some gas production at its South Pars field after an Israeli strike,
Okay, that's tangible.
and Israel reportedly targeted an oil depot in Iran. These things might not stop global flows immediately, but they remind everyone how vulnerable the infrastructure is, especially when the market's already tight.
And didn't something else happen near a critical choke point?
Yes, and this is crucial. On Tuesday, two oil tankers collided and caught fire near the Strait of Hormuz.
Oh, wow. The Strait of Hormuz, remind us just how important that is.
It's incredibly vital. It's the narrow waterway connecting the Persian Gulf to the open ocean,
Yeah.
basically. About a fifth of all the world's seaborne oil goes through there every day. We're talking somewhere between, say, 18 and 21 million barrels daily.
A fifth of the world's oil. So any disruption there is a massive deal.
Huge. And this collision happened when there's been a reported surge in electronic interference in the area, messing with navigation systems during the conflict. That adds another layer of risk. Some shipping companies have already paused journeys through the area.
So you've got the immediate risks, the fire, the interference. That's really putting traders on edge. But stepping back, what about the longer view for oil? Demand, supply. There seem to be some really different opinions out there.
Yeah, if you connect these immediate risks to the bigger picture, it gets even more interesting. The International Energy Agency, the IEA, just put out forecasts that paint one picture.
Okay, what's the IEA saying?
In their latest report, they actually lowered their forecast for demand growth this year slightly to about 720,000 barrels per day, but they revised their supply growth forecast up to 1.8 million barrels per day.
More supply, less demand growth.
Right, so their takeaway was basically, unless something major blows up, oil markets look well supplied in 2025.
Well supplied. That sounds almost calming, given the headlines. But I know that's not the only view out there, is it?
Not at all. And here's the really crucial part of the IEA view. They project global oil demand will actually peak by 2029.
Peak demand by 2029, that's soon.
Relatively soon, yeah. At 105.6 million barrels per day, then a slight decline in 2030. Meanwhile, they see production capacity growing significantly, maybe reaching almost 115 million barrels per day by 2030.
So potentially a lot more supply capacity than demand down the road.
That's what the IEA model suggests. Their director, Fatih Birol, said markets look set to be well supplied. But he did add that big caveat about geopolitical risks to supply security.
Okay, so that's the IEA view. How does that stack up against, say, OPEC's perspective?
It's a sharp contrast.
Yeah.
OPEC, the producer group, sees demand growing for much longer.
Oh.
They don't see a peak anywhere near as soon as the IEA does. This isn't just, a minor disagreement. It's a fundamental split on the future trajectory of oil.
And that split has huge implications for investment, for policy, everything. What about the big consumers, China, the US? How do they fit into this diverging picture, especially with EVs and the energy transition?
Well, China's situation is changing. For years, they drove global oil demand growth, but that's slowing down now. Economic headwinds, plus a really strong push into electric vehicles. The IEA actually thinks China's oil use could peak as early as 2027.
China peaking soon.
Yeah.
So what about the U.S.?
That's the other side of the coin, and it's fascinating. The U.S. is still the world's biggest oil consumer, and the IEA has actually boosted its forecast for U.S. oil demand in 2030 by 1.1 million barrels per day compared to what they thought before.
Boosted U.S. demand. Why? I thought the EV transition was happening here too.
It is, but maybe slower than initially expected, according to the IEA. They point to lower gasoline prices sticking around and EV adoption not taking off quite as fast as they previously assumed. They now think EVs will only be about 20% of U.S. car sales in 2030.
Only 20%. I remember much higher predictions.
Exactly. Last year, they assumed 55%. So that's a huge downward revision for EV penetration in the U.S.
And this is where it gets really interesting for you, our listener. Because if the energy transition is slower in the US, that has massive ripple effects on global demand, on oil prices, on climate policy. It changes the whole calculation. The future of energy is definitely not straightforward. Okay, so moving away from commodities for a moment, central banks, currencies, they're always reacting to this shifting landscape. How did the US dollar do amidst all this uncertainty?
The dollar strengthened. It gained ground against the euro, the pound, the yen on Tuesday.
What was driving that dollar strength?
Seems like a couple of things.
Mm.
One, maybe increasing caution from U.S. consumers, worries about trade, inflation. And two, those vested concerns about the Middle East conflict escalating. Classic safe haven appeal for the dollar, too.
Right, so specific moves.
The euro dropped almost 0.7% against the dollar to around 1.148. The dollar index itself was up by about the same amount, 0.69%. Sterling also fell against the dollar, down over 1%, ahead of their inflation data and the Bank of England decision.
And the yen, always closely watched.
The yen fluctuated a bit. The Bank of Japan finished its meeting, kept rates steady, but outlined a plan to slow down its balance sheet reduction. Ultimately, though, the dollar gained against the yen, too, up about 0.36%.
So, a stronger dollar overall. What does all this mean for interest rates? Especially with the Fed making their announcement today. Everyone's waiting for that.
Yeah, that's the big question today, isn't it? The overwhelming expectation is that the Federal Reserve will keep interest rates on hold, right where they are, in that 4.25% to 4.50% range.
Hold is expected, but the economy is showing some mixed signals, right?
It is. You've got some signs of softening business sentiment, consumer sentiment had dipped, but then the labor market is still, well, surprisingly solid, creating about 125,000 jobs a month on average, and inflation is still cooling, even if slowly.
So the Fed's got a tricky balancing act.
Absolutely. They're juggling the potential impact of tariffs, changes in government spending plans, and now this added uncertainty from the Middle East and what it might do to oil prices and inflation down the line. It's a lot to weigh.
How are traders seeing it? What are the odds they assign to a cut today or soon?
For today's meeting, almost zero. The market's pricing in just a 0.1% chance of a rate cut today. That's way down from almost 3% just last week.
Wow, okay. So definitely expecting a hold. When do they think a cut might actually happen?
The focus has really shifted to September. Traders see about a 63% probability of a rate cut at the September Fed meeting. And looking out to the end of the year, they're anticipating roughly 45 basis points of cuts in total.
45 basis points. So maybe 1 or 2 quarter-point cuts by year-end is what the market's betting on now.
That seems to be the general consensus priced in, yes. A basis point for listeners is just 1/100th of a percentage point.
Right. So, okay, if a hold is baked in for today, what is everyone watching for in the Fed's announcement? It's all about the dot plot, isn't it?
Exactly. The dot plot is key. That's where the Fed officials anonymously plot out their individual expectations for where interest rates should be in the future. Investors will be glued to that, looking to see if the median projection for 2025 rate cuts changes.
What did it show last time, and what might change?
Last time, back in March, the dots implied the equivalent of 2 quarter-point rate cuts this year, 2025. That actually lines up pretty well with where market pricing is right now.
So the question is, will they stick with that, or will they signal fewer cuts ahead?
That's the million-dollar question. They have to factor in not just inflation and jobs, but also things like immigration policy's impact on labor supply, regulatory changes, government spending, and of course those potential tariff effects we mentioned. It's a complex economic soup.
And quickly, what's happening across the pond? Europe.
Eurozone government bond yields picked up a little bit. Markets there are also recalibrating expectations about how quickly the European Central Bank might continue cutting rates. And German investor morale actually improved more than expected in June, which is a little bit of positive news out of Europe.
Okay, so a lot of moving parts globally. What an eventful period we're covering. We've really seen how things like tensions in the Middle East, or even just one policy decision about tax credits here, can send these big ripples through markets everywhere.
It really does underscore how interconnected everything is now.
Absolutely. And for you, our listener, hopefully this serves as a good reminder that being aware of these bigger trends, even the ones that seem far away, can actually give you some surprising insights. Insights into your own finances, sure, but also just understanding the world around us.
Couldn't agree more. It's this constant interplay, isn't it? Geopolitics, economic numbers, central bank moves. It creates this incredibly dynamic, complex picture. I think the real key is always trying to look past the headlines.
Understand the why.
Exactly. Understand the underlying drivers and appreciate that there are often very different competing perspectives shaping what happens next. As we navigate all this, maybe something to think about is how that big difference in long-term oil forecasts we discussed, the IEA versus OPEC, how might that fundamentally reshape energy strategies, investments, even geopolitical alliances in the years ahead? That's a really big question.
A very profound thought to end on. Thank you for your attention. You can subscribe our podcast if you like it.